Good morning, and welcome to today's webcast, Jumpstart Your ESG Reporting. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Fike, and Madison, Poitras. Casey is a senior manager in our enterprise systems consulting practices and specializes in Workiva ESG implementation. Madison has practiced internal audit with a focus in environmental, social, and governance since 2015. Her strong ESG background has equipped her with a comprehensive understanding of sustainable practices and their intersection with the corporate strategies and internal control structures. With that, I'll turn it over to Madison to get us started.
Great. Yeah, thanks, Chad. Hi, everyone. It's really nice to be here today. I'm excited for today's session. We have an exciting agenda with what is ESG, the business case for ESG. I'm going to talk about ESG strategy, and then I'm going to pass it over to Casey to talk about data management and reporting, and then I will conclude us today with a regulatory compliance update. So without further ado, what is ESG? So I'm sure many of you are already familiar with this acronym, but for those that may not be, I want to provide a quick refresh just to make sure that everyone understands at a high level what this means. So ESG is really a set of factors that businesses are globally using to help better capture and communicate decision-useful information to a variety of audiences. It's really an opportunity for organizations to tell their story, whether that's taking credit for all of their ESG objectives, and many times it's acknowledgement of improvement areas and goals to be better in the future and to drive your competitive edge. Sorry, it was on the wrong slide there. So here's all of the stuff I was just talking about. Apologies about that. So yeah, at a high level, this set of factors helps better capture and communicate your information. And this next slide here are ESG topics broken down within each letter: environmental, social, and governance. So starting with the environmental, the E considers how an organization performs as a steward of nature and the global environment. Environmental information, as you can see from this slide, includes consideration of greenhouse gas emissions, the use of water and the release of waste, and the use of other natural resources such as forests. It includes greenhouse gas emissions, which I'm sure many of you have heard about. It's a really hot topic right now, energy efficiency, land use, and then moving on to the S for social. So the social refers to how organization manages their relationships with employers, suppliers, customers, and the communities it serves and where it operates. It refers to resources contributed really with relationships through humans. You can hear it referred to as human capital or human capital resources. These include information of privacy and data security, pay equity, policies and procedures that support workplace culture. And then last but not least, we have governance, which refers to a bunch of different areas, but really focusing on ethics, enterprise risk management practices, executive compensation and incentives, and lobbying and even political activity at times. All right, so what is the business case for ESG? There are many different reasons why people, initiate an ESG strategy or do different types of ESG reporting. These bullet points here just list a couple of areas, but in general, it can increase your access to capital. Investors are increasingly considering ESG factors in their investment decisions. Companies with ESG profiles may have better access to capital as they are perceived as lower risks. Operational efficiencies. So ESG initiatives often lead to more efficient use of resources, such as energy and water efficiency, which can result in cost savings. Waste reduction and sustainable supply chain practices can also contribute to operational efficiencies. Risk management, I'll talk about this a little bit later in our webinar today, but we're seeing a ton of ESG regulations come out. So ESG practices can help identify and mitigate various risks, including environmental risks like climate change, social risks such as labor issues, and governance risks like corruption. So companies that are proactively looking at these ESG risks can avoid potential costs and liabilities. All right, and now we're going to do a fast and furious session on implementing a successful ESG strategy. So why is it important to tell your ESG story? And the answer is a lot of different reasons, right? We just went over those business cases of building trust, attracting investment and access to capital, enhancing your brand value, regulatory compliance, but how do you tell a valuable and useful ESG story? So I like to break it down into different bullet points, starting with like being authentic. Ensure your ESG story is genuine. You don't want to just share your successes, acknowledge challenges and describe how you're addressing them. This helps build credibility and trust. Use data to support your story, and Casey's going to talk a lot about data. Quantifiable data and evidence-based outcomes lend credibility to your narrative. So highlight metrics, highlight achievements that showcase your progress, such as reductions in carbon emissions, improvements to employee diversity, or employee engagement or community engagement impacts. Connect to your core values, so align your ESG initiatives with your entity's mission and values. This helps stakeholders understand that your ESG efforts are an integral part of who you are as a governing body. And then continuously update your story. So it's not a one-time thing. There are regulatory updates, there are stakeholder preferences that change. So this ongoing communication helps keep your story and relevant and top of mind for your customers and stakeholders. So once you understand your business case, you want to tell your ESG story, what's next? You need to assess your ESG current state. So looking at this slide here, you can see it's broken down into 4 different components, from risks, resources and capacity, leadership, and strategy alignment. So starting with risks, you'll want to understand what your risks are, whether that's that regulatory compliance risk you may be applicable for the SEC rule or the California Senate bills or CSRD, greenhouse gas emissions reporting related to climate risk, greenwashing risk, as we're seeing a lot in the news as of late, reputational damage risk, so understanding your risks, resources and capacity. You'll want to understand what resources you have available and the capacity to complete your ESG initiatives. Do I have a dedicated team to accomplish these tasks? Do I have partnerships or technologies in place to ensure that we can accomplish these tasks? And then we have leadership. Do we have proper oversight of our ESG initiatives at the board level, at the management level? Are the appropriate teams involved? And strategy alignment. Do we have people, processes, systems, and supporting strategic plans to ensure strategy alignment? All right, and then this slide here is just putting it all together. So you are telling your ESG story, you understand your current state, you understand your gaps. From there, you can target your objectives, create your metrics, your KPIs, and make sure you can measure your progress. And then that leads to an ESG story. And with that, I'll pass it over to Casey to talk through data management.
Great. Maddie, thanks. I think, a couple of points you brought up around kind of setting the strategy is, which I'll jump into now, is how are we telling our story, right? And I think for a lot of our clients, that's the issuance of an ESG report, which I'll talk through that process and how we bring some efficiency to that process. Right. I think probably for a lot of people on this webinar, hey, we're thinking about implementing an ESG strategy, reporting on that so we can thereby tell our story. But I think with that is after we've decided on our metrics, what are we going to report? How do we pull that all together, right? And I think a lot of times we hear from our clients is there's a lot we're trying to pull into a single document that's public facing, where from what I've been seeing, there's a lot of risk from or not necessarily risk, but just a lot of rigor that the SEC is enforcing around this publicly facing document, this publicly facing report. So is to kind of talk through these challenges we're hearing from our clients as they're pulling through their ESG report. It takes a lot of time. There could be a number of different metrics. We're working with a client now. They're reporting 40 different metrics over multiple years. Those metrics are coming from different systems, different individuals. It's kind of that scattered data right there on the slide that we're seeing that takes quite a bit of time and honestly introduces quite a bit of risk on how is that data being delivered into our final ESG report. Is it sent via email? Is it, hey, it's in a Slack message? Challenges there on just pulling that data where somebody might fat finger something in an email, or maybe it's coming from a calculation within an Excel document, a third-party system like Watershed, for example, to report on our water usage. But then finally, when we get all that information into our report, the actual review is we have multiple versions of an ESG report kind of flying around, where it's our CFO might be on version 2, our head of sustainability might be on version 6, our legal team, who's the last review, might be on a different version. That's a challenge that we're hearing where there's so many different versions and we're trying to figure out which one's the right one. So what we found and what we help our clients with from those challenges I was talking about is utilizing Workiva's ESG module. So kind of high level laid out on this slide, which I'll get to in some more detail in the next couple of slides, is here is how Workiva works to bring a lot of efficiency and accuracy to your ESG reporting process. Kind of leading off is that those data collection tasks, those are individual requests that, again, stay within the Workiva platform to say, you need to go populate a metric, or we need to ingest data from this third-party system. That ties into the ESG program, which, again, as I mentioned, I'll get into a little more detail in the next couple of slides. But all of our ESG metrics that we're reporting on for whichever year that might be are all located within, again, the Workiva platform within the ESG program. That then connects to the ESG fact book, which is kind of a holding ground, if you will, for our metrics that are going to go into that ESG report there. So again, big picture is single source of truth, data linking, visibility to those metrics, review process, and report creation, all within a single platform. So what we're looking at here is just a sample metric within Workiva's ESG program. It's a little bit blurry, but if as you can see, we can kind of provide that person providing the data, a description to the metric, whichever ESG framework, which Workiva comes with a handful of ESG frameworks pre-built, what that metric is linked to within the specific or multiple ESG frameworks, year. And then you can also see this metric's been assigned to Maddie. I'm the reviewer. We can define multiple reviewers. We can define due dates for those metrics, how those metrics are to be populated. Again, all within a single platform, so no more kind of running around chasing down the approvals. We can see within dashboards, reports within the program or the platform, where we are in our review process, our data acquisition process. You can send reminders to say, please populate, please review. There can be multiple steps of approval. Again, however your organization is pulling this data together, the platform can meet you there. The next slide here is that Workiva fact book or data ingestion I was talking about, where, again, publicly facing data, publicly facing metrics, publicly facing report, the data has to be accurate, right? Our shareholders, our stakeholders, the general public is all invested in this. We need to report in a complete and accurate manner. So what we can see here is the internal carbon price, that highlighted cell, is at $1,000. We can see that source right there on the right-hand side of the screen to understand where is this coming from? Where is this data coming from? And then on the next slide, which I'll show, is where that data is going to. So when I think about, and I saw a question pop up in the chat from Sarbanes-Oxley controls perspective. I think about data traceability or even information provided by the entity. How can we have an audit trail to understand how that data is flowing through the platform? And then can we connect maybe any sort of supporting documentation if it's maybe not a direct connection to a third-party system, as I was mentioning. But here's how that number was calculated. Again, it might be in Excel, but I look at that Excel document as supporting documentation from a controls perspective, from a data accuracy perspective. And then finally here, another look, and I mentioned this earlier, but you can create your ESG report within Workiva. But as we can see there in that highlighted cell in the upper right-hand corner of the report, that $1,000 is then linked to our end report. So again, what we're looking at here is kind of the end product of that data collection, that data linking, that data reporting. I can then see again, where is that data coming from? And then further, the review process that I mentioned, this can all happen within the platform. So no more multiple versions of a report going along or moving about. It's a pretty powerful tool in the sense of reporting and data collaboration. Again, we've run into clients where, hey, we started this in Google Sheets, which great first step, but I think with, these third-party tools like Google Sheets, you lose that data traceability, you lose the auditability. Security is a challenge where it's kind of all or nothing within a Google Sheet. So anybody who may not be a metric provider or a metric reviewer can go in and modify those metrics that end up in your report and again, go out to the public. So again, within here, we can create versions again within the platform that might be redlined or updates. I can provide access to individuals. Again, I'm thinking our legal department. Who's that last reviewer for your report? We can provide them access to this. They have access to what we're looking at. They can provide their comments. There's a comment feature to say, I'm not clear on how this metric was created, defined, presented. Please provide feedback. That all happens within the platform again. So I just think from what we've seen from our clients, data is coming from all over. It's a pretty big challenge to pull it all together, keep that data accurate, secure, and that's where Workiva really steps up to get everything on a single platform, so we can have our data acquisition, our data linking, our data review all happen auditable, traceable. That said, Madison, I'll pass it back to you.
Great. Thanks, Casey. All right. Now it is time for our ESG regulation update. So I'm going to start with the SEC climate disclosure rule. This is a really hot topic right now. So to give everyone just some general background, this rule was originally proposed by the SEC in March of 2022. So on March 6th of this year, the SEC issued the final rule. So this final rule will require information about a registrant's climate-related risks that have materially impacted or are reasonably likely to have a material impact on its business strategy, results of operations, or financial condition. So the final rules leverage some concepts from the TCFD framework, which is Task Force on Climate-Related Disclosures, which I'll talk about in a little bit for California Senate Bill 261. But just to let you know that TCFD framework is a core component of the final rule. We also do want to note, as of April 4th, the SEC voluntarily stayed the effective date of the rule. The stay does not reverse or change any of the final rule's requirements. The outcome of the litigation is unknown at this point in time, and the review may take several months or longer. It is uncertain whether the SEC will retain or extend the final rule's current compliance dates, which I'll show in just a little bit. We're monitoring this closely. That being said, it's still really important to understand what these disclosure requirements are and the resources and the time and, as Casey was mentioning, the IT controls that go into place, the technology that you'll need to in order to be in compliance with these disclosures. So here's a high-level summary. Just given the time that we have today, I won't be able to go into the details of this, but starting with applicability. So essentially this rule applies to all registrants, including emerging growth companies, smaller reporting companies, and foreign private issuers. Impacted filings would be your registration statements and your annual reports. Materiality, the US Supreme Court's definition of materiality, the SEC is pushing this really hard as a materiality qualifier throughout the rule. Certain financial statement disclosures and those SX requirements are subject to specific thresholds, and then compliance dates, which I will get to in just a little bit. So here, this slide here is a snapshot of the rule. It just gives the core themes of the rule and really just kind of the nature of the rule and these different components. So starting with climate-related goals and targets and material climate-related risks and how those have had or reasonably likely to have a material impact on the company's business strategy, results of operation, or financial condition. Activities to mitigate or adapt to a material climate-related risk. This includes quantitative as well as qualitative descriptions. Board oversight, this is a huge component of the rule, including board, but also management's role in assessing and managing those climate-related risks. Material, so again, here's that materiality qualifier, only if material scope 1 and scope 2 greenhouse gas emission disclosures. This is only applicable for large accelerated filers and accelerated filers. SRCs and EGCs are exempt from this. You'll notice scope 3 has been completely scrapped from the rule. There were many public comments and concerns about scope 3, and so the SEC has removed scope 3 from this final rule. And then last but not least, we have these financial statement disclosures, which includes the effects of severe weather events and other natural conditions related to costs and losses. And here is the table that I was talking about. So on the left side, you can see your registrant status from large accelerated filers to accelerated filers to SRCs and EGCs. And then to the right, you'll see those SK and SX requirements. So the first compliance date for a large accelerated filer would be FYB 2025. FYB stands for any fiscal year beginning in that calendar year listed. So for example, if you're a domestic large accelerated filer, you would begin including your disclosures in your December 31st, 2025 10K for that first column. The columns 2 through 4 on the end, the material expenditures, those are SK requirements, and the SEC gave another year to be able to comply, realizing, registrants might need to implement new systems, might need to further develop their DCPs, which are disclosure control procedures. And then on the right side, we have our greenhouse gas emissions. So as I mentioned, the scope 1 and scope 2, if material, are only for those large accelerated filers and accelerated filers. And you can also see that only reasonable assurance is required for large accelerated filers. Only limited assurance is required for accelerated filers. So another change from the proposed rule there. All right, we're now going to jump into the California Senate bills, starting with California Senate Bill 253. This bill is also known as the Climate Corporate Data Accountability Act. So this bill will require any public or private company earning over $1 billion in annual revenue that has California operations to publicly disclose their greenhouse gas emissions. Revenue applicability will be determined based on the reporting entity's revenue from that prior fiscal year. So entities will need to submit their emissions information to an emissions reporting organization that will be designated by CARB. CARB stands for the California Air Resource Board. So they will develop a publicly accessible digital platform for your emissions data. You have to calculate your greenhouse gas emissions in conformance with the greenhouse gas protocol. So just pausing here, let's say you are applicable for the SEC rule in addition for California Senate Bill 253, you're a large accelerated filer or an accelerated filer. You'll notice Scope 3 doesn't have a materiality qualifier. It's included in California Senate Bill 253. So something to consider is all ESG regulation applicability. You don't want to just look at the SEC rule and be like, oh, I'm good, just Scope 1 and Scope 2, and then realize, oh, I actually need to do Scope 3 for California Senate Bill 253. So a couple more details here on timelines. So as the bill is currently written, the bill will require all applicable companies to disclose their Scope 1 and Scope 2 emissions starting in 2026. So this would be over your 2025 data, and then Scope 3 beginning in 2027. There are assurance requirements as well in this bill. So Scope 1 and Scope 2 emissions will be performed at a limited assurance level beginning in 2026 and a reasonable assurance level beginning in 2030. So what's next? The governor has publicly commented he is working to adjust timelines, understanding that 2026 timeline may be infeasible. So hopefully more to come in the near future on those timelines. Moving on to California Senate Bill 261, this is also noted as the Climate-Related Financial Risk Act. So this is applicable to private or public companies with over $500 million in annual revenue doing business in California. So this is the TCFD framework that I was talking about. The SEC final rule builds off this framework, and you can see this is the core component of California Senate Bill 261. So again, that applicability not only to understand one regulation, but to understand them all, because you might want to use whatever work you've done for California Senate Bill 261, and that can be leveraged for the SEC rule work because it's built off this framework. Tentative timeline is on or before January 1st of 2026. So you can see that common theme of 2026 keeps coming up. And then last but not least, here is just for those that aren't as familiar with the TCFD framework, it's broken into 4 different components from governance, strategy, risk management, metrics, and targets. So if you look through the SEC rule, you can see these themes throughout the rule, from the governance requirements to the strategy and how it's impacted by material climate-related risks, risk management practices, and then metrics and targets. All right, and with that, I just want to take this one last slide to hopefully what you took away from our very short, but hopefully helpful webinar today, understanding your organization's business case for ESG and implementing a successful ESG strategy can lead to bottom-line growth, operational efficiencies, and brand strengthening. Casey, Workiva is a solution that brings efficiency and transparency to your ESG reporting process. And then last but not least, the ESG regulations, these continue to evolve. And it's really important to understand your compliance dates and reporting requirements. We have a bunch of different ESG services to help with Workiva implementation or your ESG strategy or your ESG regulatory compliance. Let's say you're now thinking about your greenhouse gas emissions. Maybe you've already calculated your greenhouse gas emissions, but you're not quite there, not quite ready for that assurance opinion yet. We can do a reporting readiness assessment, identify your gaps, make sure that you feel ready for assurance when the time comes, a gap analysis across the ESG regulations and being like, this is your current state, this is where you need to go, and here's your future roadmap on how to get there. So really appreciate your time today. And with that, I'll pass it over to Chad to close us out. Thank you.
Thank you, Casey and Madison, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.